Hello, class. This is Dr. Carl Atmendi, and this is a chapter 15. This is chapter 15 from our personal finance text, and the chapter is titled Owning Stocks. Owning stocks. As an investor, you buy stocks hoping to share in corporate profits, benefiting directly from the inventive vitality of the economy and participating in economic growth. Stocks and stock markets learning objectives. Explain the role of stock issuance and ownership in economic growth. Contrast and compare the roles of the primary and secondary stock markets. Trace the steps of stock issuance. Contrast and compare the important characteristics of common and preferred stock. And explain the significance of American depository receipts for U.S. investors. More on stocks and stock markets. So then here we have like kind of somewhat of a workflow. We have the inventor or the entrepreneur, friends and family, debt, angel investors, venture capital, private equity, and then you go public. So obviously, the inventor or the entrepreneur is the person who creates the product or the service or the company. So I give you kind of like an example. A couple of years ago, a couple of friends and I came together to create a patent for a product that we wanted to sell. And this is also the workflow, kind of like not specific to stock markets, but also whenever there's like when you're doing new product development. So we came up with this idea, right? And we gathered with friends. We did have to have some money out for our invention so that we can put money together and get all the proper licensing and all that we needed. Now, angel investors, venture capital, private equity, this is all part of the fundraising process. So it may say this in the book, or you can also search it yourself. Angel investors are just people who are willing to invest in new ventures or venture capital firms. These are firms that provide money to entrepreneurs who produce like their own companies and whatnot. And in return, usually they will want to own a certain percentage of your company and of its profits. So they have to really believe in your product. So essentially, the entrepreneur will have to pitch the sale to the angel investors, venture capital, private equity firms, and then it goes public. Um, so in here we have a little bit more added: entrepreneur, friends and family, debt, angel investors. So this is the fundraising part. You go public, the primary market offering, and then secondary market trading. This is the difference between common stock and preferred stock. Whenever you have common stock, and you'll have pretty good definition of common stock and preferred stock from the text, but when you own common stock, you do have voting rights, so you can make. Usually, you'll get like you. I used to have stock in Advanced Micro Devices and Intel, which produces microprocessors, and usually you'll get like a voting form, and the voting form entitles you to check boxes. It's kind of like a survey, and then you send it back, and then depending on how much stock you own, um, then you can help influence and shape the company. When you have preferred stock, you usually don't have voting rights. I'm also tempted to say that this should be no, because I mean it's one of the aspects of preferred stock is that there's less privileges. When there's common stock, you have more downside risk. When it's preferred stock, you have less. And common stock is usually a little bit more volatile than preferred stock. When there regarding upside risk, there's more in the common stock as opposed to preferred stock. Reliability of investment income, there's less in common stock because there's risk involved. So since there's the element of volatility, which is here, then your investment income is a little bit more reliable with preferred stock. But the price you pay is that you don't get voting rights, and they're you don't have the opportunity to profit as much as you would when you take the risk and go in for common stock. So again, price volatility, there's more with common stock and then much less with the preferred stock. Some key terms, some key organizations here. American Depository Receipt, or ADR, are the number of shares of foreign corporation. Now, ADR is usually also an acronym which stands for Alternative Dispute Resolution, so you want to make sure that you don't get confused there, which is a whole different thing, which is a different way where two people or two entities resolve conflicts. But ADR here is All American Depository Receipts. American Depository Share, or ADS, is a share of foreign corporation. Companies go public to raise capital to finance growth by selling equity shares in the public markets. A primary market transaction happens between the original issuer and the buyer. Secondary market transactions are between all subsequent sellers and buyers. The secondary market lowers risk and transaction costs by increasing liquidity, and shares are authorized, then issued, then outstanding. Equity securities may be common or preferred stock, differing and by the assignment of voting rights, dividend obligations, claims of bankruptcy, and risk. Now, with regards to dividend obligations, I've seen both common stock issued that don't pay dividends, and sometimes it's just because the company decides to do that. Maybe they have a really good product. You can also check on Google Finance. I really like Google Finance because it shows you how much dividend they paid out per stock and when they paid it out. And if you enter a couple of companies, you can see that some companies are more consistent with when they pay dividends. Others pay it like, only during 1 year. Some other companies don't pay it at all. So dividend obligations can change, not just between common and preferred stock, but within each other too. I mean, some companies do issue dividends and some don't. Uh, Claims in case of bankruptcy, and then risk. Risk is an element that's more common with the common stock as opposed to the preferred stock, which is a little bit more secure. But again, like we mentioned in the previous slide, um, with the preferred stock, you don't have voting rights, and that's usually something that's not, um, you know, not preferred by the investor unless you have like a significant amount of stock in the company and your vote is worth more. Common stocks have less predictable income, whereas most preferred stock have a fixed rate cumulative dividends. American Depository Receipts, or ADRs, represent foreign shares traded in U.S. markets, lowering risks such as currency risk and transaction costs for U.S. investors. Stock value, learning objectives. Explain the basis of stock value. Identify the factors that affect earning expectations. Analyze how market capitalization affects stock value. Discuss how market popularity or perception of value affects stock value. Explain how stocks can be characterized by their expected performance relative to the market. The value of a stock is in its ability to create a return, to create income or gain in value for the investor. So that's the objective there. Corporations exist to make profits for the owners. The better a corporation is at doing that, the more valuable it is, and the more valuable are its shares. So now, in um, in many in many situations, we hear the word value. Now, most of the time, value, like if we use it colloquially, is something that cannot be measured. Like or maybe it can, but like if someone were to ask you how much do you value your education, you will say, well, I value it very much. So then there's no way to really quantify how much you value how much value you put in your perception as opposed to someone else. But when we're talking about stock and we're talking about value, it's not like a hypothetical value or like a figurative value. It's a specific value. So when we're talking about stock value, we're talking about a number. We're talking about a dollar amount. How much is the stock valued at? And then that's what we're talking about. So again, the corporation exists to make profits for the owners. And the owners are the shareholders of the corporation. The better a corporation is at doing that, the more valuable it is, and the more valuable are its shares. If you could know that the future value would likely be more than the current market price over your transaction costs, tax consequences, and opportunity costs, then you would buy the stock. If you thought the future value would be less, you would short the stock or borrow it to sell it with the intent of buying it back when its price falls, or look for another investment. So this is all part of like some of the complexities of the financial markets. Um, you can either buy a stock. You can either buy a stock and hold it, buy and hold, with the anticipation that the price is going to go up and up and up over time, and that in a designated time, whenever you want to, you sell the stock and then you keep the profit, right? So I'll give you an example. I had shares of Stem Pharmaceuticals. No, it was the ticker symbol was STEM. I think it was Stem Cell Pharmaceuticals, and basically they were valued at like $1 or something like that. So I bought some stock in Stem, and basically what they were doing is they're a pharmaceutical and a biotech company, and they're one of their core objectives is to try to find a cure for cancer. So now, if you look at what's happened in the public health arena and the pharmaceutical companies, like over the last couple of decades or even hundreds of years, technology has advanced. We have made significant discoveries over time, and those discoveries help to save people. So now we have something as simple as penicillin, right, or aspirin that we can buy. Aspirin we can buy over the counter, and it can save your life. Like it can save you from a blood clot or any other type of like coagulating blood coagulation in the circulatory system. That's a miraculous discovery. So do I think that STEM or any other of its competitors are going to find a cure for cancer? I definitely do. When? I don't know. So I took advantage of the fact that it was just $1, and then I bought it, buy and hold. So that's one strategy of you're being hopeful that the company is going to fulfill its objective, and that one day there's going to be a boom. Once that company or one of its competitors can find a cure for what they're trying to look for. Now, if you want to short the stock, short means that you're actually hoping that the stock value is gonna drop in price. So you borrow it to sell it with the intent of buying it back when the price falls. So then that's one way of trying to like lock in a certain price when the stock value goes down, and then you're hoping that it'll go up. So then this is the whole objective and the idea of a speculative market, and that speculation drives the cost, or the price rather, of stock, which unfortunately has also caused a lot of controversy, because when a company puts out stock, their objective is to try to raise capital. That's the main objective of them. I mean, otherwise, why would they sell stock to people who are hoping that the stock value would go down? And there's all sorts of things like rumors and aggregate sentiment, which is the epicenter of my research, um, negative publicity, scandals that can drive the cost of the price of the stock to go down. So now, if you want an example of the volatility, using Apple here as an example because I'm an Apple person, look at try to find a news article when Steve Jobs announced publicly that he was sick and that he had pancreatic cancer, and then look at the stock value of that day, and then of the next couple days after that, and then see how news has an ability to influence stock value. So when we're talking about indicators of earnings and growth potential, we're talking about economy, industry, and the company size, right? And the size can be many. It can be a micro cap, small, mid, or large. So here we have growth stock. Its definition is underestimated potential for growth. Its role is to expect a higher rate of return. right? Value stock is undervalued by the market and underpriced. Expect a higher than average return. Defensive stock are less volatile than the overall market and less sensitive to market changes. Expect the value to fall less than the markets during the market decline. Cyclical stock is more volatility than the overall market and more sensitive to market changes. So when we're looking at cyclical stock, retail would be a pretty good um, example of this, right? You're looking at a stock, and then all of a sudden in December or with the holidays, you see an increase, and then it goes down again. So then it's kind of cyclical because it depends on the seasons more so. When the market rises, expect the price to rise at a higher rate. When the market falls, expect the price to fall at a higher rate. So then this one is correlated also to the market overall. Speculative stock are overvalued by the market and overpriced. Expect the price to continue rising before it falls. And some good examples of this could be like IT stock. There was a lot when in the dot-com boom of the early 90s, a lot of speculation there. Blue chip stock, stock of a stable, well-established large cap company, expect stable returns. Window and orphan stock, blue chip defensive stock, expect a steady dividend. Wallflower stock, overlooked and therefore underpriced. Expect the value to rise when the stock is discovered, like stem cell pharmaceutical. And penny stock, low price stock of a small or micro cap company, expect the value to rise if and when the company succeeds, which is also another good example of the penny stock doesn't necessarily have to be a penny. It could be valued very low, 50 cents or whatever, but this is all still considered penny stock. These terminologies are more for like descriptive purposes, but they aren't really used a whole lot in stock um, terminology. But it's good to know so that you can differentiate the behavior of each one of the stocks with each other. A stock's value is based on the corporation's ability to create and grow profits. Earnings and expectations are based on economic, industry, and company specific factors. The size of the market capitalization affects stock value. A stock's market popularity or perception of value affects its value. Stocks can be characterized by their expected behavior relative to the market as growth stocks, value stocks, cyclical, defensive, or other name types such as blue chip and penny stocks. Common measures of value. Identify common return ratios and evaluate their usefulness. Explain how to use contributed capital in determining diluted earnings per share. Explain how to interpret dividend yield. Explain the significance of growth ratios. Explain the significance of market value ratios. Common measures of value. So here we have different types. We have return ratios, we have growth ratios, and then we have market value ratios. So starting with the return ratios, you have earnings per share. So this is like a small percentage of each share and how much increase or decrease you have. Dividends per share. You have dividend yield. So that's kind of like in previous slides we talk about interest rate. So this is kind of like the interest here, depending on how much the stock is valued for. And yeah, so here earnings per share, earnings for each share, dividends for each share, and then cash return per $1 investment. So it's usually like a percentage is the best way to see it, to understand it rather. Growth ratios, you have the dividend payout rate, which is the percent of earnings paid out. The retention rate, which is the percent of earnings kept for growth. Internal growth rate, the maximum rate of growth with no outside capital. Sustainable growth rate, maximum rate of growth without issuing more shares. And the market value ratios, you have the PE ratio, which is price to earnings, which is the market value of earnings, and the PB ratio, which is price to book, a market's value compared to the original value. So these are all ratios that are used. Morningstar.com does a pretty good job of showing these ratios. It's my favorite, actually. Google Finance shows like a good histogram showing like the performance of the stock over a designated time period. But when it comes to comparing stock based on these ratios to determine performance, Morningstar does a pretty good job. So here we go. Earnings per share. It measures earnings in dollars for every outstanding share of stock. Dividends per share measures dividends in dollars for every outstanding share of stock. Dividend yield is the dividend in dollars returned for every dollar invested in stock. The dividend payout is the percentage of earnings paid out as dividends. The retention rate is the percentage of earnings retained as capital. Internal growth rate, the fastest rate of growth without using more debt or issuing more equity. Sustainable growth rate is the fastest rate of growth using more debt but without changing the balance of debt and equity. PE ratio is the market's value for each dollar's worth of earnings, and the PB is the market value of the company's equity compared to its book value. Key takeaways: earnings per share or EPS and dividends per share DPS indicate stock return on investment. Contributed capital is used to calculate diluted or minimum earnings per share. Dividend yield measures a shareholder's cash return relative to investment. Growth ratios, such as the internal and sustainable growth rates, indicate the company's ability to grow given earnings and dividend expectations. Market value ratios, most commonly price to earning and price to book, indicate a stock's market popularity and its effect on price. Equity strategies, learning objectives. Identify and explain the rationales behind common long-term strategies, and identify and explain the rationale behind common short-term strategies. So here's an equity strategy long term. You have buy and hold, which I mentioned before, which is something that I did with stem cell pharmaceuticals, advanced micro devices, and Intel. Dollar cost averaging, direct investment, dividend reinvestment, and indexing. And these from here forward, I'm talking about these four, are usually strategies used by wealth management companies. The most common type of strategy for people who want to do investing on their own is buy and hold. And usually, depending on the volume of your transaction, it's not worth it. Like, um, if you're gonna buy like a couple $100 worth of stock, for example, in the transaction cost and the brokerage fees, you might, you if you factor that in, it might not be worthwhile for you to do that. And in terms of long-term retirement planning, it may be better to just put your money into a 401k, 403b, and also make sure that your employer has a matching program that you can take advantage of to make some gains on that. But yeah, moving forward, for buy and hold avoids market timing and lowers transaction cost. Dollar cost averaging avoids market timing and lowers transaction costs as well as schedules investments. Direct investment lower transaction cost. With dividend reinvestment, you avoid market timing, you avoid stock selection, and you lower transaction costs. The investment is scheduled. And indexing avoids stock selection, lower transaction costs also. Usually, an index is a collection of stocks together. And if you go on Morningstar, you'll be able to see if you go a little bit more, not just into stocks and bonds, but also like in the indices and into mutual funds, you'll be able to see a couple of those there. For equity strategies, buy and hold avoids market timing, as does dollar cost averaging and dividend reinvestment. The dividend reinvestment and the indexing avoid stock selection. To lower transaction costs, all of them, buy and hold, dollar cost averaging, direct investment, dividend reinvestment, and indexing. And to schedule investment, which results in saving, dollar cost averaging, and dividend reinvestment. And this will not make sense unless you flip open the book, your personal finance book, and you go to the chapter and you see how these are applied to real world situations. Short term, day trading is a very short term strategy of taking and closing a position in a day or two. Sorry, coffee break. Literally, it means buying in the morning and selling in the afternoon. Day traders. And I've known a couple of day traders. Common long term strategies to maximize return by minimizing transaction costs or minimizing the effects of market timing. Long-term stock averages include buy and hold, dollar cost averaging, direct investment, dividend reinvestment, and indexing. Common short-term strategies try to maximize return by taking advantage of market timing. So now, just going back to day trading for a sec. Now, usually when you trade, there's a platform that you use to execute that trade, and there are some trading platforms that are used, like for example the Bloomberg terminal. And if you want, you can Google it, Bloomberg terminal, and it'll look familiar to you because the Bloomberg terminal are the computers that are shown in like in the movies, and when you see videos of like the stock market floor. It's the one with the three screens and the colored keyboard. So that you have, generally, companies pay a membership to have that, and it's usually, the last time I checked, about 10,000 a month, I think. So it's a relatively expensive program for average people to have. But day trading is that act of sitting there when the stock market opens, executing trades, doing research, and doing this and that until the trading day closes. So usually you won't do day trading if you're using a platform like ING, or if you're using a platform like um, what is it, like TD Trade and or E Trade, because when you execute the trade, it's not going to be instantaneous. It's usually going to take a bit. They have to process the transaction, and that defeats the purpose of day trading, because when you day trade, you want to execute the trade at the moment that you specify. And this concludes the chapter 15, owning stock. This PowerPoint presentation was meant to be like a general overview, more than anything, of the chapter. It goes a lot deeper into owning stocks in the book. And if you have any questions, please feel free to contact me at any time. And since I am a big advocate for promoting engagement in the classroom and participation, if you're watching this video, I'm willing to give you extra credit for watching it. And to do so, just to verify that you did watch the video, just send me an email with what this image is right here on my screen, and I will give you extra participation points. Again, if you have any questions, comments, or concerns, please feel free to contact me at any time, and I will gladly assist. Have a great day.